Welcome back. In this video, I'm going to talk about free cash flow valuation models. We also have two other videos. They are called Valuation Based on Comparable Firms. And we have a third video on information competition and stock prices. This slide is about the discounted free cash flow model, also called DCF. And the DCF model determines the value of the firm to all investors, including equity and interest-paying debt holders such as banks. The equation goes as follows. The enterprise value, which is the present value of all future cash flows, is equal to the market value of equity, which we also call market cap, plus interest-paying debt less cash. Let's have a look at a more simple example. Here the 200 is the present value of all future cash flows, which is equivalent to the enterprise value. The company has a bank loan of 150 and zero excess cash. That means that the market cap or the market value of the equity is 50. What does that mean? It means that if this organization is going to be sold to another company, then the other company needs to pay 50 to acquire the organization. So you may wonder, okay, if this company is for sale, why are we not going to demand 200 in terms of a sale price? Why 50? Well, because the potential buyer is not going to pay for any debt, and that's why he is going to pay 50 to acquire the assets and not 200. Let's have a look at the more basic principles of valuation before we're going to do an advanced DCF. First, you need to determine the future cash flows. Then you need to discount all the cash flows with a cost of capital, which we also call discount rate. And once we've done that, we have calculated ourselves the present value. And please know that if you're going to determine the expected cash flows of an organization and you're going to discount that with a cost of capital, you end up with your enterprise value. Okay, so the building blocks for calculating your enterprise value are cash flows and cost of capital. We also call this the valuation triad. That is, you have future cash flows discounted with a cost of capital will give you the enterprise value. And these are the basic building blocks of a valuation model. Now, how does this work? Let's assume that we have an opportunity that offers a payment of 10,000 euros after 1 year, and the cost of capital is 10%. That means that you have a future cash flow of 10,000. The cost of capital is 10%, so we're going to discount the 10,000 with 1.10 to the power 1, because it's 1 year, gives us a present value of 9,091. So the present value of 10,000 today is 9,091. So the 9,091 is the equivalent value today of receiving 10,000 after 1 year. If you're going to invest 9,091 in an investment fund and the banker is going to promise you that you're going to get back at the end of the year 10,000 euro, so you put in 9,091 and you're going to get back at the end of the year 10,000, then the difference is equivalent to a return of 10%. This table shows you the application of the discounted cash flow model for bonds, stocks, businesses, and projects. In column 2, we have the type of cash flow that we need to calculate the underlying value. This is the type of discount rate that we use, and this is the time span. Looking at business valuation versus project valuation, we can see a big difference between the two. It's not the cash flow, it's not the cost of capital, but it's the time span. A business is valued based on going concern, meaning that the assets produce a cash flow until the infinity. while the projects have a limited time span. This is because the underlying cash flows are related to an asset with a limited economic life. Please note that we have a separate video on the valuation of bonds, and we have a separate video on the valuation of stocks using the dividend discount model. So the enterprise value is calculated as the present value of all future free cash flow to the firm. And cash flow to the firm is calculated as revenues less costs less depreciation expense. And remember from our financial statement video, this is what we call EBIT. And from the EBIT, we're going to deduct our taxes. And if we do that, we create what we call NOPLAT, which is net operating profit less adjusted tax. And to go from NOPLAT to cash flow, we need to add up the depreciation, and we are going to deduct our capital expenditures in our fixed assets, and we're going to deduct our investments in net working capital. So in sum, the NOPLAT plus depreciation less our investments is what we call our free operating cash flow to the firm. If we want to go from enterprise value to the price per stock, we can use this equation, and V0 is the enterprise value plus excess cash less interest paying debt gives you the market capitalization or the market value of the equity. If we divide that by the total number of shares outstanding, we will derive the price per stock. Remember that the cash flow to the firm goes to both equity and debt holders. That also means that the equivalent cost of capital should be related to both equity and debt capital. And therefore, the discount rate that we use in calculating the enterprise value is called the weighted average cost of capital, also called the WACC. On this slide, the equation is given for the calculation of the enterprise value. What is important is the first set of cash flows, which we just call the regular cash flows. They're discounted at a cost of capital. And we have the terminal value. Okay, so we have the regular cash flows and we have the terminal value. And remember that if the firm does not have any debt, the cost of capital is equal to the cost of equity, because for the simple reason that there is no debt in the capital structure, the only capital that we are going to use is the equity capital, and therefore the WACC equals the cost of equity. Let's have a closer look at our terminal value, which is Vn. And the equation of Vn is over here. And essentially, the terminal value refers to the present value of all your business's cash flows at a future point, assuming a stable growth rate until the infinity. So the terminal value is capturing all of your cash flows beyond a specific time period until the infinity. Remember that the terminal value needs to be discounted as well until T0. So in a nutshell, this is what you're going to get. So you're first going to calculate your individual cash flows. You're going to discount your individual cash flows with the cost of capital. Then you're going to compute your terminal value. And then you're going to discount your terminal value until T0. And the sum of all of that is what we call enterprise value. Let's have a look at an example. So Nike had sales of 518 million in 2020. Suppose you expect its sales to grow at a 9% rate in 2021, but this growth rate will slow by 1% per year, okay, to a long-run growth rate of 4% by 2025. So in other words, by 2025 and beyond, the expected growth is 4% per year until the infinity. The EBIT is going to be 9% of sales. The increases in net working capital requirements are 10% of any increase in sales, and the CAPEX equals depreciation. If Nike has 100 million in cash, 3 million in debt, 21 million shares outstanding, and the cost of capital is 11%, what is then your estimate of the value of Nike's stock early 2021? And the income tax is 37%. Good luck. In this table I have provided the answers. In the first column I have the breakdown of the cash flow items, and here we have the years. Now the first thing that we need to calculate is obviously sales. And what we said in the case is that the growth rate in 2021 is 9% compared to 2020. However, this growth will slow down with 1% per year until 4% in 2026. The EBIT is 9% of sales. Okay, we are going to deduct our income tax, which is 37%. Then we're going to deduct our investment in net working capital. For the rest, we have no investments. We also have no depreciation. So we can actually calculate our cash flow from sales, EBIT, NOPLAT. This difference is NOPLAT. Less all the investments is going to give us our cash flow. So we're now going to calculate the enterprise value. First, what we're going to do is we're going to discount every individual cash flow until 2026, okay? So 27.4, 30.1, etc. until 39.9. You can see them over here, okay? So for example, 27.4 divided by 1.11 to the power 1, and the one in 2026 is going to be 39.9 divided by 1.11 to the power 6, okay? So this actually forms, if you add all this up, you actually have the first building block of your enterprise value. Then in the second building block, we are going to compute the terminal value of all the cash flows in 2027 and beyond. Okay, so from 2027 and beyond. Well, the 2027 cash flow equals the 2026 cash flow. However, there is a growth rate taken into account. Okay, so if we take the cash flow of 2026 and we are going to include the growth rate and of course the cost of capital, and you fit it in this equation, we will have a terminal value at 2026, okay, of 592.8 million. Remember that, and I've just said it, the 592.8 million is the present value of all cash flows of 2027 and beyond at 2026. So the terminal value needs to be discounted until the early 2021. So for us to do that, we need to discount this amount with 1.11 to the power 6. Because if 592.8 million is the present value of the cash flows of 2027 and beyond, at this point in time, we need to discount that back 1 year. So from here to here is 1 year, 2 years, 3 years, 4 years, 5 years, 6 years. Okay? So we can see that over here. So in sum, we have the present value of all the individual cash flows plus the present value of the terminal value gives us the enterprise value. So on this slide, I copied and paste the equation from the previous slide, which gives us an enterprise value of 456.9 million. Now, if we need to calculate the stock price, we're going to use this equation, and it looks like enterprise value 456.9 plus the excess cash less the interest paying debt. Of course, this will give us the market capitalization, so the market value of the equity. We divide that by the number of shares outstanding, which is 21 million. So the market cap divided by the number of shares outstanding gives us a stock price of 26.38. Let's have a look at the connection between enterprise value and capital budgeting. Now, the firm's free cash flow equals the sum of the cash flows from the current and future investments. So the enterprise value can actually be broken down into the NPVs of all projects. So in sum, if you would add up all NPVs of every individual project in your organization, you would end up with your enterprise value. That also means that if you would like to maximize the firm's share price, you should accept projects that have a positive NPV, because projects with a positive NPV add financial value to the firm. Let's have a look at example 2, in which we are going to include some sensitivity analysis in the case of Nike. Now, in example 1, we have seen that the EBIT of Nike was assumed to be 9% of sales. If Nike can reduce its operating expenses and raise its EBIT to 10% of sales, what is then the impact on the underlying stock price? I have given you a hint because the EBIT is going to increase in the first year with 5.6 million. And the after-tax cash flow is going to increase with 3.5 million to 30.9 million. Good luck. Let's have a look at the answers of example 2. The first thing that we're going to do is to recalculate the cash flows in 2021 until 2026. Then we're going to discount these cash flows with the cost of capital. Okay? Then the second step is to calculate the terminal value in 2026. And remember that the terminal value in 2026 is equivalent to the cash flow in 2027 and beyond. So in other words, the present value of the cash flows in 2027 and beyond is what we call the terminal value in 2026. Okay, so the terminal value gives us an amount of 664.1 million at 2026. So we need to discount that 6 years back. 1, 2, 3, 4, 5, 6 years back. Okay? So, in sum, we have the present value of all the individual cash flows plus the present value of the terminal value gives us a new enterprise value of 512.5 million. Then the price of the stock is the enterprise value plus the excess cash of 100 million less the debt divided by 21 million stock gives us a new share price of 29 euros and 2 cents. So we have come to the end of this video. My suggestion is to open the next one, which is called Valuation Based on Comparable Firms. Thank you.